Hello friends, welcome to the Fund Talk. So typically if you look at the stock markets are typically driven by two emotions, greed and fear. If the greed is there, then you tend to be overboard on the equity side of the market. And if the fear is more, then you are underweight on the markets. So my name is Sandeep Singhi and hello friends. Today we would be discussing about hybrid funds, and with us we have Mr. Srinivasan Ramamurthy. He is fund manager for equity assets for various funds such as HDFC Hybrid Debt Fund, HDFC Equity Savings Fund, HDFC Balance Advantage Fund, HDFC Retirement Saving Fund, HDFC Asset Allocator Fund of Fund, and HDFC Multi-Asset Fund. Hi Srini.
Hi Sandeep.
So first thing first, let's start discussing about the hybrid funds. So I wanted to understand from you, what are hybrid funds and what are the various types of hybrid funds that are available with us?
Sure. Hybrid funds are those where you have two or more asset classes which you combine together, and different combinations of their weights can drive different risk return outcomes for the overall product. Broadly speaking, in case of India, in addition to equity and debt, gold is one other asset class which is very dominantly used. Elsewhere in the world, you will find even asset classes such as real estate investment trusts or your alternate assets also being used quite extensively. However, they are not so deep and liquid in India to be used at scale as we speak, but I'm sure that will change with time. The idea behind hybrid products is obviously that you are getting something in between a pure debt product and a pure equity product. So to that extent, it can, from a range standpoint or the type standpoint, you can have a hybrid product which is relatively more conservative, which gives you debt plus kind of a return. Two products which are a lot more aggressive, and they can give you equity like or equity minus returns, but with some reduced level of volatility. So that's broadly, I would think, the thought process behind most of the hybrid products.
Shini, we discussed about what are hybrid funds and what are the various types of hybrid funds. So can you elaborate us on why one should consider investing in a hybrid fund?
Right, sure. See Sandeep, the reason why any individual buys an asset management product in the first place is to cover for some expenses that you incur in the real economy, right? It might be an education cost, it might be your healthcare costs, or your day-to-day expenses, particularly post-retirement, for instance. You will have expenses to be taken care of, and as we know, all these things scale with inflation. So to that extent, for any product, it becomes important that you are able to beat inflation over the long time frame, and that becomes one overarching need. At the other end, you don't want too much of volatility and sharp drawdowns in your portfolio in the short term, because that impedes your ability to use up these savings of yours when the need arises for you. So to that extent, products which can give you a lower level of volatility helps from that standpoint. So clearly, when you want to beat inflation over the long time frame, equities are a preferred asset class. They do the job very well. And when you want to have lower levels of volatility, the traditional fixed income products are the place to go, because they serve the purpose well. But most of the requirements that we have in real life are actually somewhere in between, right? You want to draw in, have regular incomes, and you want to withdraw on a regular basis, and at the same time you want to create wealth for the future as well. So whenever you're dealing with these kind of real life situations, and you want to match both of these outcomes, hybrid products do the job well for you. In addition, the added advantages that you have in case of an hybrid product is also the fact that you have frequent rebalancing, and hence whenever you rebalance the portfolios, the risk adjusted returns obviously keeps improving as you go forward. And another benefit which is more from an investment behavior standpoint is clearly because of the lower levels of volatility in these products, you don't have those extreme periods of greed and fear overtaking you, where mistimed entries and exits are possible from the funds itself, which we see quite often the case with pure equity products. Here, those instances are also one can expect them to be lower.
Correct. And one more important point, since you were touching on the rebalancing part, so there is a basic tenet which says that buy low, sell high, and I think hybrid funds fit into that category very well, because when you are rebalancing, the markets are high, you are selling equities and buying debt, and when the markets are low, you are buying equities and selling debt. So buy low, sell high, it's a tenet which the investor individually would be difficult to do it, but through a fund house, through a fund manager, this has been able to do it.
Absolutely, and in a very tax efficient manner. Absolutely.
Srini, today the total mutual fund industry AUM is close to about 40 lakh crores, and out of which almost about 12-13% is the hybrid funds, and within that 12-13% of hybrid funds, the two asset classes which acquire the most of the AUM is the aggressive hybrid fund or the balance advantage fund. In our case, it is the HDFC hybrid equity fund and HDFC balance advantage fund. So can you elaborate some differences between these two categories?
Right. Yeah, I think both of these are, like you mentioned, fairly popular categories, and both of them are equity oriented and hence enjoy the equity taxation benefits. But the biggest difference is clearly in case of equity hybrid or the aggressive hybrid product. You have a much narrower range in terms of the equity allocation. You work with a 65 to 80% kind of an equity allocation range. Whereas when it comes to balanced advantage, when we talk about the unhedged equity exposure, that can be much wider. I mean, you can work with 0% to 80% or 0% to 90%, as in our case. You can use that entire range for your unhedged equity, and hence it becomes a product which is very well suited for doing dynamic asset allocation, and you can move between this range of equity based on the relative attractiveness of equity, and what it also does is obviously that in case of balanced advantage, because of the ability for you to move in a wider range, you can obviously try and reduce the volatility of the product through asset allocation changes, as and when you perceive higher levels of risk in the market.
Srini, since we were talking about HDFC Balance Advantage Fund, so can you just elaborate us how the equity allocation has been decided in Balance Advantage Fund?
Right. So in case of HDFC Balanced Advantage Fund, we follow a framework-based approach towards determining the asset allocation. So here we have a three-layer approach. In the first layer, we try and determine what is the valuation looking like for the equity markets relative to debt as well. So here we use two parameters, the trailing price to earnings ratio and earnings yield to bond yield ratio, based on which we come out with a range of asset allocation. What we do to this range is we try and fit the overall macro environment into another framework, and try and ascertain which macro regime we are currently in, and based on that we make some adjustments to this valuation based range that we got in the first step, and finally we provide this macro adjusted range to the individual fund managers, and they have the option to be at the lower end or the higher end of the range, depending on the actual bottom-up analysis of the investment opportunities as the way they see it within the marketplace. And just to add to this, normally we try and work in a range of 40 to 80% for this product, and while we have the flexibility to go from 0% to even 90%, but obviously in situations where which demands us to go beyond 80 or to come below 40, we will not shy away from doing that.
Okay, Srini, and how frequently would this be rebalanced? This is done on a daily basis, weekly basis, or a monthly basis?
No, so most of the parameters do not change very meaningfully on such very short frequencies. So what we try and do is that we try and ascertain most of these parameters that go into the framework on a monthly basis. So based on the month-end data in the first few days of the next month, we come out with our allocation ranges, and then the fund manager has the opportunity to make these changes as he deems fits in the marketplace.
Srini, can you take us to a real-life example how this model would work in a HDFC Balance Advantage Fund?
Sure. So let us assume that the valuation environment is such that based on the parameters that I indicated earlier, you get to a range of 40 to 50% for equities currently, just as an illustration. So what you do to that range, which is the 40 to 50% range, is you try and include the macro backdrop to it, and this could potentially add or reduce at max a 10% from this range. So if the macro backdrop is very favorable, you might want to add 10% to this range. If it is unfavorable, you might reduce 10% from this range. If it is neutral, you don't do anything to the range. So let us assume that the macro backdrop is extremely favorable, then this 40 to 50% range becomes 50 to 60%. And this 50 to 60% range you provide to the equity and debt fund managers, and they have the flexibility to be where they want within this range. So they can, if the bottom up opportunities, investment opportunities are there, they can go to 60%. If the bottom up opportunities are not as much, they might choose to stay at 50%.
In case of HDFC Balance Advantage Fund, if we compare it to the peers, we normally have a higher equity allocation. Why is that so? Can you just elaborate on that?
Right. So, see, at the core of the approach that we have towards HDFC Balanced Advantage Fund is a philosophy of wealth creation with some element of wealth protection embedded into it. And hence, to that extent, we've always had a relatively higher share of equity, but whenever the risk reward becomes very unfavorable, we do prune equity exposure. I mean, that's the way we have traditionally run this product. But as we speak, over the last few months, we have transitioned to a more framework-based approach, and which is clearly dependent on, as I indicated, valuations and your macro outlook. So to that extent, one should expect that these variables will drive the asset allocation more closely in the future, and then there might be some reduction in gap with the peer set as we move forward to that extent. But having said that, the core of the product remains unchanged in terms of the philosophy and what it wants to achieve.
I think wealth creation and wealth protection are the two important themes. So if we are considering about a wealth creation type of a product, then probably we may have a little bit of higher equity allocation.
Yeah, absolutely. I think that's the way to think about it. I mean, that's one would be a primary objective. The second would come to the fore when, like I mentioned, the risk reward outcomes in the marketplace look more unfavorable. Correct.
Shini, can you also elaborate on what is SWP, which is also known as systematic withdrawal plan, and how it is beneficial if somebody opts to do SWP from a hybrid fund?
Sure. So, like you might be aware, systematic withdrawal plans have become a reasonably popular option to generate a regular income from your investment products. And given the fact that, like I mentioned earlier, hybrid products traditionally have a lower level of volatility compared to your pure equity products, to that extent, it becomes a little bit more amenable to such plans. Because you do not want to be systematically withdrawing from a product when markets are down very meaningfully or there is a heightened level of volatility. But given that they keep it they moderate the volatilities that you experience, they are more amenable to that, and it's obviously a much more tax efficient way to manage your income flows. So yeah, I would think that they go hand in hand with hybrid products.
And I think retirees who are looking at the regular cash flow, they can also consider these products for SWP. It's a newer frame, but it's like an opposite of what a SIP is, which is a systematic investment plan. So in nutshell, asset allocation is key to wealth creation. It's about how much of equity you are investing rather than when and which asset class you are investing in. And HDFC, through its host of the products, make it easy for you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.